Hello and welcome to S&C Critical Insights. Today, we'll discuss our thoughts on the future of European capital markets activity, and in particular, how issuers can be prepared for open windows. I'm Carsten Berrar, managing partner of the firm's Frankfurt office and co-head of the firm's capital markets practice. Joining us today are John Horsfield-Bradbury, partner of our London office, and Krystian Czerniecki, partner of our Frankfurt office.
One, of course, big topic for every successful capital markets transaction is being prepared for open windows. At S&C, we are working with a number of issuers who need to raise capital now. However, others may have a longer time horizon, as we discussed, and simply want to be prepared for when a window opens. John, what should issuers be doing now to ensure that they are ready? And are there any lessons that can be learned from companies that have gone through the capital raising process in the past few weeks or months?
Thanks, Carsten. I think it is critical for a European company that's considering access to US markets, whether on a registered or 144 basis, to consider the disclosures that their US competitors or comparable companies are making. If you take the hypothetical where a US company discloses risks and contingencies that are applicable to its business, especially if that's in areas that the SEC has indicated are critical for investors. If a European company doesn't have such robust disclosure and undertakes an offering in the US, and then one of those contingencies comes into effect in a COVID world, then that would provide an easy roadmap for a plaintiff lawyer to bring a claim in under the US securities laws. So I think there's value in keeping track of companies' disclosure in the US, especially as the US companies start to publish their 10Qs in which they're required to update their risk factors. Changing tax, another point that needs to be borne in mind are the relevant corporate entities that will need to provide approval for any financing. Of course, this is always the case. I think companies have been good about providing frequent updates to their boards about the impact of COVID-19, but maintaining that discipline, and in particular including updates on potential financing needs in the state of the market, will be important, especially if, as I mentioned before, an issuer may be considering new kinds of instruments that are novel. Obviously, it goes without saying, as markets move quickly and unpredictable, there can be a significant benefit in being ready to access them on short notice.
Sure, totally agree, John. Krystian, one other key question that we often get in times like today is how could issuers adjust their transaction structure, especially for IPOs, to address the current situation?
Well, look, I think the big challenge on any IPO transaction coming out of the crisis is going to be valuation. Investors are going to be historically have after crisis are going to be looking for higher IPO discounts than they might otherwise. Issuers will be coming off of doing the offering on the back of Q1 or Q2 numbers, which will be in many cases negatively affected by the crisis and the related lockdowns, and so obviously that's going to put a lot of pressure on the valuation analysis. And so in that context, what people are really going to be looking for is flexibility. Interestingly, as a U.S. lawyer, I'm often struck by the difference between the U.S. and the European market in this regard. In the U.S., you can price above or below the range. You can upsize the deal or downsize the deal within relatively generous parameters without needing to go to the SEC or obtaining any form of approval. In Europe, of course, that's not the case, or often not the case, as changes of the type that I just described would typically require an amendment to the prospectus, which has to be approved by the competent authority. And at least on the downside, going late in the game to reduce the price range is often a death knell for the transaction. And so people are going to be looking for ways to make changes, including last-minute changes, or to increase flexibility. In Germany, one of the things that we see is transactions which are done using what's referred to as an upsize option, So the transaction is perhaps scaled back in terms of its overall size going out, but with a view to potentially increasing the transaction in a pre-approved form in the event that the market demand is there. And the green shoe would then come on top of that. 10 or 15 years ago, when in Germany there was frequently, because of gray market trading, pressure put on price ranges such that deals were pricing below the range, or sometimes because of the approval process necessary in that case being pulled, people came up with a technique called the decoupled approach, where you go out without a price range and add the price range in an amendment to the prospectus, which is sort of pre-planned 3 or 4 days before pricing, in the hope that way you'll be able to build a momentum in the market without having a price range out there that people could attack, and hopefully resulting in ultimately in a higher valuation. I think overall deal sizes are probably going to come down. I think certainly the PE exit sponsors may well be looking at the prospect of post lockup secondary transactions at a higher valuation, but off the basis of the listing that they would have achieved at the lower valuation earlier in the game. That I think is on the IPO front what I would say.